Hi everybody, Jeff Rivett, Portfolio Manager with Creed Capital Management at National Bank. Hope that everyone's having a wonderful start to the summer. I thought I'd take this market update outside in appreciation of the beautiful season, and hopefully everyone's getting out, getting a lot of vitamin D, enjoying this beautiful weather. I know I've been down at the beach with the kids as much as I possibly can, just soaking it all up, and certainly hope that you and your families are doing the same. It's been a wonderful start to the summer for the markets as well. June was a nice up month, which was great to see after May was a bit weaker. In fact, the market's up now over 20% since October, which is a nice rebound. In fact, technically, many would argue that's the sign of a new bull market. And therefore the end of the bear market that we had in 2022. So that's a huge positive. I know that our own analysts and economists at National Bank have been sending out information talking about how when we've had these 20% moves up in the market in the past, that typically good things have happened. So that's the hope for the coming months anyway. Most of the performance, the positive performance, continues to be led by the tech sector. Certainly in our U.S. names, we've benefited a lot from the strength in the tech sector this year, specifically in our holdings in Apple and Amazon and Google and Microsoft. Have just been outstanding performers. It is an area that we did trim. I know in my last update last month I talked about how those have become such a dominant part of the market. These few companies that you need to be careful because they're getting very, very big. So we did trim back a bit on some of our tech names this past month. Not a lot, but just took some of the gains that we'd made and added that to a bit of gold. Just added a bit more to that, just with inflation continuing to be there, although much less so, and just sort of the catch up that we believe that gold is still due. Also, the safety that it provides us in case things do go the way that we don't want. So certainly trimming the tech sector has been a big push for us this month. Another change that we made was getting out of Northland Power in our models. It's a company we didn't own for very long, but was certainly one of the sort of toughest stocks that we held in our Canadian portfolio, and added back into Fortis, which is a name that we've owned before. Hasn't really moved since the last time we sold it, but the dividend is extremely steady. They've paid a dividend for decades consistently and grown that. And with inflation, one of the greatest things for utility companies, especially monopolies like Fortis, is that they're the only game in town, meaning that we all have to buy from them. They could basically charge us whatever they wanted. So they are regulated as to what they can charge by the government. And with prices going up, with inflation, there is the opportunity for them, unfortunately for us, to raise their prices. But as owners in the company, that is certainly a positive. Also with these kind of companies, the sort of these higher dividend paying companies, that seems to be sort of where we're starting to shift to and where we see the next year coming. And that's largely to do with the fact that the interest rates that we're earning on bonds are just so favorable, meaning that in a lot of the corporate bonds that we own, the preferred shares, we're seeing safe interest rates and dividend yields of 5 to 7%. So, in that environment, when you're looking at what am I getting in equities for the additional risk that those come with, it becomes a bit more challenging. If you can make sort of 5% relatively safely, how much more do you need to make to take the risk in stocks? And so when you look at our overall positioning, really since I guess February this year, we have been on the more sort of neutral to conservative end of our equity weighting, and certainly in our balance model. Our balance model currently has about 56% in equity, and we can be anywhere from sort of 50 to 65. So we're on that sort of safer end. again, in favor of bonds, which provide us that predictable, safe return. And with the equities that we do own, again, having that dividend income is extremely attractive, because we don't necessarily expect there's going to be a major run up in the stock market and a huge rebound broadly. We expect that the economy is going to be resilient. Certainly it has been much more resilient than probably was feared last year. Inflation is seemingly under better control. I know in Canada and the US, we're seeing inflation rates down to 3 or 4% now, compared to 8% that we had last year. So that's a huge win. And I think, it's certainly frustrating, especially for those with variable mortgages and with those with floating rate debt, to see rates so high. But as investors, we really need to, I should say, as investors, economic stability is the most important thing, and that's really what all these rate hikes and everything are meant to give us, is economic stability. We don't want to see inflation running away from us, and I think that one of the biggest sort of concerns that I have, and I've shared this with many of you that I've met with, is we are in a very fortunate position in Canada, where most people do have fixed mortgages. We're a conservative people, I guess, much more so than in the US and elsewhere. But because we have fixed rate mortgages, rates can go up, and it doesn't have a huge negative effect right away. But a lot of the mortgages were either taken or refinanced coming out of COVID, sort of in late 2020 and late 2021. Which means that for many folks on a 5-year fixed mortgage, 2025, late 2025, and early 2026, we're going to see a lot of people having their rates increased if we're under the same scenario we are now. So in some ways, with even though we're still seeing rates rise and we're seeing the day-to-day pain of that in the economy, I do think it's a manageable pain, and it seems that the economy is still stable, and while things might not be flying and we might not be seeing tremendous economic growth, I think we're seeing stability, and that's the most important. So all in all, things look stable. Again, we have a conservative approach to our equity holdings. Certainly still favoring bonds. I know in our newsletter this month we talked about GICs as an option as well. Certainly not as a long-term investment option, but great for any short-term cash needs. Taking advantage of that is great. And in general, just ensuring that we stay the course and continue to guide money safely through every economic environment. So that's it for me for this month. Again, hope everyone has a wonderful summer, and look forward to speaking to you guys as certainly we have our meetings coming up in the fall. And if nothing else, talk to you next month. Goodbye.